Welcome back to Scaling Up Not Giving Up, the show for founders doing things differently. Today's guest is someone who's quietly transforming how we talk about business value, not with hype or hustle, but with data, depth, and a refreshing amount of common sense. Dave Bookbinder is a business valuation expert, best-selling author, and host of the Behind the Numbers podcast. He's also the guy behind the phrase that's now echoed around the world: you better get the human capital part right. In this conversation, we explore why your people don't show up on a balance sheet, but should. We get into the real cost of toxic employees, the dangers of founder dependency, and why culture isn't just fluffy HR talk, it's a valuation lever. If you've ever wondered what your business is really worth, or what's quietly subtracting value while you're scaling, this one's for you. So let's go. So I'm joined today by Dave Bookbinder. We're going to have a really interesting conversation about business valuation, business worth, value, and what's not on your balance sheet. So Dave, I guess first up, give us a little mini history of yourself and what you've done in your career for our listeners that may not have came across you before.
Yeah, sure. Well, first of all, thanks for having me on the program. I'm thrilled to be here. As you said, I'm Dave Bookbinder. Currently lead the valuation practice for an accounting firm called Hafley Flanagan in New Jersey, outside of Philadelphia. I've been a valuation / corporate finance guy for my entire career, way longer than I care to admit. And I've helped clients in valuing their businesses and their intellectual property assets for a lot of reasons. And along the course of my career, one of the intellectual property assets I valued was human capital, people, and didn't particularly think that my profession told the whole story about the value that people contribute to a business enterprise. And oh, by the way, every CEO on the planet says your people are your most valuable asset, but they don't appear on a balance sheet. So one day I decided to actually write something about that. And that one article turned into a series, which became a book, which I never intended to write. And then there was a second book that followed that. And recently, at the beginning of this year, I just dropped a third book, which is called Valuation Toolbox for Business Owners and Their Advisors. The first two books that I refer to are the new ROI, Return on Individuals. And it's my journey to prove that people really are a company's most valuable asset. And when I'm not doing all of that, I host the Behind the Numbers with Dave Bookbinder podcast, which you can get everywhere.
Amazing. So I guess let's dive straight into that point then. Why are our most valuable asset not on the balance sheet? And how could you even put them on the balance sheet? Because it feels like you're valuing a person.
Oh man, I don't know that we've got time to go down that rabbit hole completely, but let me start by saying this. There was a time in my career where the assembled workforce, which is the proxy for people, was on a balance sheet and it was listed as an identifiable intangible asset, the assembled workforce. The accounting rules changed years ago, and that workforce is no longer reported on the balance sheet. Workforce is considered what we call in our industry a contributory asset. It's not a definitive or defined intangible asset, Richard. It's something that contributes to the value of other intangibles. So for instance, your customer relationship asset isn't going to be worth much if you don't have a workforce behind it supporting it, right? So it's considered from that perspective. It's a supporting cast character, if you will. And oh, by the way, intangible value doesn't get booked unless it's acquired. You can't create it and put it on your balance sheet. So when we're talking about putting people on a balance sheet, whether it's subsumed into goodwill as it is currently, or when it actually was on the financial statements years and years ago, it was only the acquired workforce. So again, you're still not getting the whole story.
Okay. And so like, I think when we had our pre-call, we talked a little bit about Tony the Tiger. Give us an example of that, because that's IP, which would go on your balance sheet.
Yeah. So the Tony the Tiger example makes the point I was just referring to here about intangible assets don't get recorded on the balance sheet unless they're acquired. So the Tony the Tiger example that I referred to. So Tony was a homegrown icon for Kellogg's. Everybody knows Tony. It's an IP asset, trademark, but it's not an asset on their balance sheet because it was something that they developed in-house. However, Kellogg's acquired Keebler, so the Keebler elves go on the balance sheet as an acquired intangible asset.
But if Kellogg's had invented something, it would go on their balance sheet, right?
No, you're not going to be booking the intangible on the balance sheet.
But if they'd invented a new piece of technology, would that not go on the balance sheet?
I'm going to say it depends, but they wouldn't be booking their trademark asset on the balance sheet.
Yeah, cool. That makes sense.
Yeah, there'd be costs associated with the development of technology.
Yeah. So I guess what's one way that CEOs can surface this hidden value before an acquisition conversation starts? Because it's not on the balance sheet. So how do you talk about that value that is your people if you're going into an acquisition situation?
Well, I think personally that people are the last bastion for value creation, and it's important that you get that part right. So the way to think about it when you're talking about an acquisition, there's data that, depending on where you get your data from, anywhere between, I think, 75 and 90% of M&A transactions fail to live up to their supposed synergies. So, the idea with them, 1+1 = 3, but most of the time it doesn't work that way. And the number one reason for that failure is the failure to integrate the people, the human capital. And I've seen it. I've been inside of organizations that are going through acquisitions. And in my consulting career, I've advised on acquisitions. And there's a lot of uncertainty when you put two companies together. And if leadership isn't absolutely keen on making sure that people are treated fairly, they're communicated with clearly, they're left to their own devices and making assumptions about what the future is going to look like for them. And in the absence of information, people tend to think the worst. And that's when you start to see departure and turnovers, and all of that institutional knowledge starts to walk out the door, and it's really difficult to replace.
Yeah, absolutely. Really, I mean, so difficult to replace good people, isn't it? And have you seen a founder lose a deal because they overestimated the value of their people or their intangible asset?
I can't say specifically with regard to the people component. There's a lot of reasons why deals crater. For me, my lens on the people piece is the future of the business going forward and the value that the people contribute to the enterprise leading up to and then after the acquisition.
And how do you explain this to someone that just wants a number? They want to know how valuable those people are. Does that make sense? No,
I get it. Because you're saying, how do you talk to the cynic who thinks that people are just all replaceable and don't let the door hit you in the butt on the way out? And why should I care? My people, they want culture. What does that mean? Can't they just shut up and get to work? I'm paying them well, right? That person? Yeah. So that's interestingly the area that I've tended to focus on, because when I wrote my first book, it covered a number of things, including how we could do a better job in actually valuing that intangible asset, people. But my contention is nobody's going to give a hoot until people actually are an asset on the balance sheet. So I focus on the value that people contribute to the enterprise, which speaks to that most cynical CEO that we were just describing here. And if I tell that person that the reason why you want to care is because if you do the right things about your people, they're going to show up for you. They're going to actually care about what they do. They're going to take better care of your clients. They're going to be evangelists for hiring and recruiting the best talent, because they're going to tell their friends what a great place it is to work at. And their productivity is going to go through the roof because they're fully invested in your mission and purpose. And all of that is going to move the needle on revenue and profits. And, oh, by the way, stock price, business value. It's all connected.
Yeah. Okay, so it's not about those people having a value as such on the balance sheet. It's about the value that those people are creating is therefore going to show up in the value of the business.
Yeah. That has a different kind of resonance, doesn't it?
Mm-hmm. Absolutely. And I completely agree. People are really valuable and culture is really valuable. I think sometimes it just gets lost a little bit, and keeping culture going is really, it's almost a full-time job. Do you know what I mean? Like, keeping culture going in a business is, I don't want to say hard, but it takes work.
It is hard. It is hard. Yeah. On my program, Behind the Numbers, I've interviewed so many leaders and CEOs and other consultants who are doing culture change and implementation on those things. And they all tell me the same story. It takes 18 to 24 months until it's really embedded in the DNA of the organization and your people understand that this isn't just another fad. We've tried the free pizza on Fridays or bring in the ping pong table, all that cliche crap. But when you get intentional about culture change, it takes time. And some of the best stories I've heard, I don't know, hopefully I'm allowed to say a naughty bit here, but one of the case studies in my first book, the CEO talks about implementing a no assholes policy. And it's becoming more and more popular. And the idea there was they created this policy. Basically, if you're an asshole, you're out. You got to play by the rules, be nice, be considerate to your colleagues. And if you can't play within that boundary, we're not going to tolerate your bad behavior. And when it was first introduced, people thought, oh, that's really cute. But when they actually enforced it, Then you get the aha, you know what, maybe they're serious. And he also learned and shared something with me that I thought was kind of interesting and funny at the same time, because if you're terminated for violating the no assholes policy at his company, you're not eligible for unemployment benefits. So he's been sued. And the fun fact is that assholes are not a protected class.
What a shame. Yeah, I have to say, recently I actually, I was applying for a board role, for an non-exec role, and I used the phrase, if you don't recruit on values, you end up with terrorists within your organization that are literally trying to, like, destroy your organization from the inside. They're literally the terrorists within. And the feedback I had after that board discussion was that I had used very inflammatory language to make my point, and I felt like it wasn't inflammatory at all. I felt like it was the absolute truth. Do you know what I mean? Like, if you have the wrong people, the assholes in your thing, they literally act like terrorists within. They infect the people around them. They try and indoctrinate those people. Like, it's absolutely disaster. But yeah, the feedback was, you used very inflammatory language, Richard. And I was like, I think I could have said much worse, to be honest. Like, I don't think you're grasping the point enough here.
Yeah. So next time you have that conversation, try to get your point, and I agree, but try using the word toxic employees, because there's a lot of research on toxic employees. And in my first book, a couple of Harvard scientists contributed to the conversation about toxic employees. And I learned something very interesting, because we're all trained when we're hiring to look for the next rock star employee, right? We're looking for that great employee. But if I asked you, are you better off looking for the next rock star or avoiding that toxic or terrorist in your terms, which way would you lean? Yeah, it's a trick question.
Yeah.
Well, the answer is you'd rather search to avoid the toxic than to search to find the next rock star, because, to your point, the toxic employees are so much more damaging to your business. In the same way that a positive attitude can be contagious, a negative attitude is very contagious. And when that happens, like you said, those are the ones that they're trying to destroy you.
And I think so, it's also worth just mentioning here, what is a superstar can become a toxic employee, sometimes overnight, but over a period of time. So, you have to be able to identify when that's happened, if it happens, because people are not always superstars forever.
Yeah, and if you bring a toxic into a situation and they start to infect your superstar, the superstars are about 50% more likely to turn to toxic.
Yeah, which is really damaging. Can you just walk us through a business that's restructured its culture and therefore saw a massive tangible valuation boost that you can think of?
There's a couple that are in my first book, the new ROI Return on Individuals, but just expounding on the CEO that I just alluded to, who implemented the no assholes policy. He and others that I've interviewed have told me the same story over time, and it impacts every one of their KPIs. So turnover goes down, retention goes up, safety goes up, revenue goes up, operating profit goes up, share value goes up. Everything it's an upward spiral when you start to do the right things about creating a great place to work.
And what metric would you say a board should be tracking to reveal the health, like if the culture is healthy in an organization?
Well, I'd probably first start with turnover, because that's going to be a big tell for you. If you start to see people are fleeing, that's a big sign that you've got a problem, because oftentimes, despite a leader's best of intentions at implementing culture change, somebody once told me culture is local, and you may have a great culture on the 8th floor, but if the guy on 6 didn't get the memo and he's treating his people a lot differently, you've got a different culture in the same firm just 2 floors below you. So watching the turnover and tracking it back to who the managers are, because people still generally don't quit their jobs, Richard. They quit their manager. And that's an important thing to know.
No turnover isn't always good for an organization. As a board, watching that turnover figure, and that turnover figure becomes really low, that could spell great culture, but it could also cause some other issues. Actually getting new ideas into an organization is good sometimes. Getting new ways of thinking is good. What's your thoughts on that? Because I don't know if it's just quite as simple as just trying to target that turnover number, keeping it low.
Yeah, no. And I wasn't explicitly saying you want to keep it low per se. Yeah, there's always going to be a natural attrition rate. It's all on a relative basis. So if your normal attrition rate is, I'm making numbers up here. If your normal attrition is 8%, and you see in the marketing department that your attrition is 37%, you got a problem. You've got to, and I hate to be cliche and kind of do a cheap plug on my own program, but you literally have to go behind the numbers to understand what's driving them. You can't just take them at face value, but those are kinds of things you want to look for. That'll be a red flag for you.
Yeah, absolutely. And what about spotting those saboteurs in the organization? Because actually you want to exit those people, those assholes that you said before. You want to try and exit those people, but that will add to your turnover. So I guess it's about like, it's kind of multiple metrics here, isn't it, that you need to be monitoring rather than just turnover.
I'm gonna blow your mind with another fun fact about those toxic employees, just to mess with your head here. Toxic employees are generally more productive than your normal employee. And the reasons seem to be that, since they tend to be know-it-alls, ego-driven, they try to get as much information as possible and withhold it. They're actually more productive. So here's a great analogy that I always use. I go back to sports. And in the US, I like to refer to American football, right? When you think about some of the famous wide receivers that have played in the NFL, many of them were considered to be bad locker room guys, but they're the best at their position, and their bad behavior off the field is tolerated because of their great performance on the field. So with regard to the toxic inside your organization, yeah, you want to at least put a cage around them. If you're able to put them in a situation where they can focus on doing their task, doing their job, and not have them infect the other members of the team, you can harness the power of their productivity, and they could be rehabilitated.
That is really interesting, because I'll be honest, whenever I've came across toxic staff members, they haven't been that productive.
I was surprised when I got that data from Harvard too.
It's very surprising, like really surprising.
Exactly.
But I guess the productivity of the people around them is maybe taking a nosedive because they're infecting them with their toxic traits. Maybe not. Would I be wrong there?
You'd probably be right there.
Yeah. Okay. And so it's really interesting, isn't it? Do you think there's ever a point where it's too late to fix the culture of an organization before you exit, or in general?
I'm an optimist. I'd like to think it's never too late. I mean, you've got to reach that inflection point to realize that you have to do something. And once you realize that you have to do something, that's day one, and you just got to start. So I would say you can't just ever throw in the towel, give up, and say, we're never going to be a great place to work. Screw it. Just if it's tomorrow, if it's next Thursday, do it, but be intentional about it.
And I guess maybe the amount of effort you may need to put in could be higher depending on how long you've left it.
Well, yeah, I mean, yes, if you've got a lot of cleanup to do, then yeah, it's going to be a heavier lift for you.
Yeah, absolutely. Okay, and so thinking about empathy then, empathy isn't on most P&Ls. Why do you think it belongs in the boardroom, and do you think it should be on a P&L as such?
Well, it's hard to put empathy on the P&L, so let me just push that aside right now, okay? That's a part of emotional intelligence, but I actually just led a fireside chat on the very topic of empathy like 2 weeks ago. And it's imperative for leaders to be able to have empathy. And we talked in my fireside chat with the group that was in the room for that, on the virtual room. When you hear the word empathy, I'm going to ask you this question. Does empathy does that evoke the feelings of being weak or being powerful?
Yeah, I think for me, it's somewhere in the middle. I don't know if I would say it was either, but I'd say it was somewhere in the middle for me.
Yeah, and most people feel that if you start talking about empathy in the corporate world, it makes you sound weak. It makes you sound...
Yeah, I can imagine. I could see that I could imagine most people would say it makes you feel weak.
Yeah, truth is, it's a superpower. There's data that supports that as well. Empathy is absolutely mission critical. I've got data in the second book that talks about the impact of empathy in organizations and how people feel more engaged, more committed to their manager, their leader, and their organization if they're treated with empathy. For me personally, that's where the whole train started for me. If you've seen any of the things I've written or any of the videos I've published and things like that, I talk about the idea of when I was a single dad for about a decade or so, I've had the opportunity to work for some leaders that did lead with empathy and some others that did not lead with empathy. And the ones that didn't, they'd roll their eyes if I had to go pick up a sick kid at work. And I realized they don't care about me, and they didn't get my best stuff all the time. The leaders that treated me with empathy and allowed me the latitude and the freedom to do what I needed to do, I would walk through walls for them. And they turned the employee engagement knob way to the right for me. And I felt it. I felt like I need to do this for this person. I need to prove that their trust and faith in me was warranted, and I would walk through fire for them. And that's where empathy comes from. You can't just make assumptions. For example, if Mary starts showing up late, Mary had always been on time. Now suddenly Mary's been late for the last 5 days in a row. You don't go up to Mary and berate her for being late for the last 5 days in a row. Seek to try to understand. Ask a few questions. Maybe Mary's got a sick kid, sick parent. You have no idea what's going on. And everybody's got something they're dealing with. So just remember, we're all humans, and try to be kind.
And what about if you're not a naturally empathetic person and you're a leader? Like, what advice do you have for those people?
Yeah, interesting you asked, because we had one of those in the room for the fireside chat. She actually said, I am not empathetic. I don't know what to do about this. So make a checklist, follow the rules. I mean, even if you don't naturally have empathy and feel like you can't evoke that emotion, jot it down. Like I just said, if this, then don't assume. And that's the big thing. Don't make assumptions. If you find yourself reaching a conclusion that's based on some assumption that's rolling around in your head, it's probably wrong. So seek to understand and ask the questions first.
Yeah, I always think it's quite useful to have like a conscience of the business as well. I sometimes find that's often an HR person, but someone that, because as a leader, you can get a bit stuck in the weeds sometimes, can't you? You can feel like, the walls are closing in, and it's easy at that point not to be empathetic because you feel like you're boxed in a corner and therefore you're lashing out. So I think it, like you said before, stop, breathe, write it down, and maybe speak to someone that's got a bit of an outside perspective on that can help you is really valuable.
Yeah, and in that example you just gave, you got to check your emotions, because I can feel it and I can hear it and I can relate to it. I've got deadlines, and Mary's now late every day this week. That's setting me back. That's impacting me. Damn it, I'm going to ream her when I see her, right? That's the emotion that you're feeling inside. That's where you've got to do the self-regulation and say, hey, on, time out, breathe. Remember, ask the question, seek to understand, don't make any assumptions, because I guarantee you, when you have that conversation with Mary and she tells you what's really going on, and you and she get on the same page, you're going to have a completely different, not only perspective, but a different level of commitment from her as well. Because now she understands that maybe you actually give her a rip about her as a person.
Yeah, it's a really good way of putting it. And what about building safety and empathy when you're all remote or hybrid? Do you think that's harder? Do you think it's still possible? Do you think it makes a difference?
It's definitely possible, and yeah, it probably makes a difference. Remote is a little bit tricky because you can't just pull up the chair. You can't get the whole body language vibe when you're talking to somebody. So there's those challenges, because sometimes the unspoken words and the body language gives you a little bit of a tell that maybe will spark some additional questions on your part. But in general, I think that the empathy component translates whether you're remote or not, just with some final, nuances and subtleties because of the remote component, but it's still imperative.
And do you think you should therefore be making regular time to just chat if you're a leader and you're managing remote teams? Because I think sometimes you really understand what's going on in someone's life from that standing at the water cooler, standing at the microwave, making your lunch with someone, talking about non-work related stuff. But actually, I sometimes find that when teams are remote, they're not having those informal chit-chat conversations. It's much harder to build that empathetic relationship.
Yeah, spot on. Definitely, if you're in the office and working together, you certainly still want to do those things. It's not just focused because somebody's remote. But to your point about remote workers, when we were going through the pandemic, and we would have our regular Monday morning meetings where we're going to talk about everything that's coming up for the week and who's working on what and how to prioritize, I actually instituted something that I call gathering time. And I told people I will be in the Zoom room 15 minutes early before the scheduled meeting time. Anybody who wants to come in and just shoot the breeze with me as if we were in a conference room, because that's what you would do, right? If you're going to show up in a meeting, you maybe come a few minutes early and chat with your buddies, chat with your coworkers. And my rules were, I'll be there. Whoever wants to show. Only ground rule was, we're not talking about work. Work starts when we conduct the meeting in 15 minutes, but for this block of time, everything but work. And it helped. And you're right. And those check-ins, sure, scheduled check-ins are good. But scheduled check-ins can sometimes feel like they're robotic and feel like maybe there's an ulterior motive and can lose some of their impact. Some of the best check-ins are the random out of the blue phone call. Hey, Richard, just checking in to see how you're doing. Wait, what? What do you need from me? My projects are on time. I'm good. No. This isn't about your projects. I want to talk about you. You good? Talk to me. What a difference maker, because that's, call it abnormal behavior. And when you do it a few times, then you're conveying the sincerity and the authenticity that you're trying to bring with it. First time, your people are going to probably be like, their radar is going to be beeping off the charts. But
that's exactly what I was just thinking. The first time they're going, oh my God.
Yeah, he never does that. What's this all about? But if you maintain that, if it's not a one-off, and if it's just part of the arsenal of checking in and genuinely caring about the people in your stead, it has a major impact. Those little moments are huge. You talked about, the well-being and asking how the family's doing. In those moments, that's where Mary might have told you that mom got put in a nursing home and she's been struggling, having to drop things off every morning before she comes to work, and the traffic patterns changed. And wow. And once you understand that as the leader, that gives you the latitude to say, well, you know what, Mary, why don't we do this then? Why don't we change your working hours a little bit so that you've got the latitude and flexibility so you don't have to feel stressed, and win-win. And look what you just did there. And imagine what kind of additional loyalty and commitment you just got from her because you understood her.
Yeah. So just thinking about your book, Evaluation Toolbox, what tools are founders most likely to overlook when they're looking at valuations?
Oh my goodness. I had to drop this book because I've had so many conversations with business owners who they don't know what they don't know, Richard. That's the hard part. There's a couple of things. Number one, they rely on information like at the golf course, for example. They're out with other business owners and somebody says, hey, I just sold my company for 10x. And they don't know what that means. And then they tell them, oh, I got 10x EBITDA. And they don't know how to spell EBITDA. They don't know what EBITDA means. They don't understand that X may or may not have really happened. Maybe your buddy was telling you something to inflate his own ego. Does 10X really apply to your industry and your circumstances? The answer is probably not. Everything is facts and circumstances based. So you can't rely on the stuff that you hear at the golf clubs. You can't rely on the rules of thumb that you read on the internet. Just so much bad information. So the toolbox was written with the idea of helping business owners understand and maybe demystify some of the things around valuation, some of the things in terms of the methodologies that you actually use to value a company. And spoiler alert, the back of the napkin method and the back of the envelope method are not valuation methods. There's actually some rigor that has to be applied to determining the value of your business. So there's a lot of good stuff in there. It's an easy read. It's short, and just some useful nuggets. I think there's a little something for everybody in there.
Surely no founders are coming to you with back of the envelope calculations.
That's all they want. It's funny because I always said this. Nobody's going to wake up tomorrow and say, I want to know what my business is worth. Wait for it. And they're willing to spend some money to get the answer. Number one, they already think they know what it's worth because they heard the number at the golf course, or they believed some rule of thumb that they heard over the years or read on the internet. What usually happens is that they're brought to me when someone else has told them they needed a valuation. For instance, maybe they're thinking about gifting shares of the business to their kids, and their estate planning lawyer says, before you can do that, you need to get your stock valued. Maybe there's an acquisition that's happening. And before you can do anything around that, you need to understand what the value of those intangibles are to be recorded on your balance sheet. So it's the accountants, it's the lawyers, it's the wealth managers, somebody else that says, before you do your thing you want to do, you need to get your business valued.
And what about founder dependency? What does that do to valuations?
Yeah, that's a great question. If your business can't run without you, your business is not worth as much as it could be. Then it speaks to, number one.
Is it worth anything?
Sure. Okay. Absolutely. It doesn't take your value to zero, but if the business goes away when you get hit by a bus, that's risk. That's huge risk. It's called key man risk in valuation parlance. And valuation is all about balancing risk and return. And everything is essentially a present value calculation. What's the present value of the future benefits of your business brought back to today's dollars at a risk rate? And when you start to evaluate risk, key man risk is one of those components. And if the business is solely relying on the leader for everything, that business disappears. If the leader's gone, that's a lot of risk, and it's going to impact your valuation.
And how, as a founder, do you know if you are still needed for everything? Because I think often I speak to founders and they think, actually they're not needed. And I've probably done this myself when I had my business. You know, you think the team can run without you, and then suddenly you realize they can't.
I'll flip the script a little bit on you. I think the ones that think the team can actually run the business without them have probably gone through some exercises in delegation, letting go of control, and some self-awareness that they don't have to be the ones that have the answers all the time. It's the leaders that are the opposite of that. The ones that feel like they have nobody else to talk to. They're the only ones who can make the decisions. They're the only ones who are going to do it right. They're the only ones that know what to do. They know it. They feel it. The question is, will they acknowledge it and do something about it to change it?
And I guess as an investor, what would your advice be to investors if there was quite a bit of founder dependency in a business?
The investor is going to take care of that. Investor is going to see right through that, and they will bring in people to replace that founder or augment that founder. Yeah, they understand that there's risk in that company. And if they're making an investment, if they're buying that business, they're going to do everything they can to reduce the risk.
Okay. And so if there's someone listening to this podcast and they're a founder, how will they know if they're the person that gets it, or they just think they get it?
If they're working 20 hours a day and feel like they can't trust their people and they're the only ones that can do this and I'm all alone in the world, if they have that feeling, that's the signal that they need some coaching, and they need to figure out how to let go, how to delegate, how to hire better, how to trust. Yeah.
Amazing. And so it feels like investors are waking up to people metrics. What do you think is next on that people-centered metrics journey that we're going?
Yeah, people are certainly waking up to it. In fact, it's an investable strategy now. There's some exchange-traded funds at Harbor Capital that are driven by something called the human capital factor that my friends at Irrational Capital developed, that basically track and correlate different components of employee engagement to stock price. And their data has been back tested for decades, and the funds have outperformed their peers in the market. And if you believe that your people matter and you want to actually put your money where your mouth is, you can actually invest in this stuff. So people are starting to see it. And I'm hoping that one day before I'm gone on this planet, that people are going to wind up on a balance sheet in a meaningful way.
And if there was 3 human capital metrics you could have in every annual report, what would they be? I assume one of them is turnover.
Yeah, I think turnover would be a good one for sure. I think investment in learning and development would be another one, because if you're investing in your people, you're going to improve those metrics. Those things have proven.
So maybe like an amount per employee per year, something like that.
Yeah, and it's all relative. Different size companies are going to have different size budgets, so you want to put it on metrics that are going to be able to allow for comparison. So those are 2 that come to mind immediately. I think don't underestimate the value that the learning and development component can contribute to corporate culture and employee engagement. I see that all the time.
But I guess if you saw a number that was really low there, you'd be asking questions when you're going into an M&A situation on why they're not.
Yeah, I mean, if you're reading an annual report, you can take a look at that. And then look, it's all comparison. So in my world, in valuation, it's all relative, right? What are you worth relative to other businesses in your market? So when you take a look at, for example, your peer group trading at a median EBITDA multiple of 8, and obviously I'm making numbers up. Do you warrant the median? Do you warrant something above that? Do you warrant something below that? It's all relative. So again, you got to go behind the numbers to understand what's really going on in each of those situations.
Okay. As we're coming at the end of the podcast, what's the one thing you'd want someone, they're driving their car listening to this right now, to take away from this conversation, to take into their business?
Well, I will say, I'm going to summarize it with a quote. This is a quote that came out of my mouth when I did my very first panel discussion about the new ROI return on individuals. And I was trying to figure out how to end the presentation without just saying something trivial like, so do we have any questions? I wanted to have some impactful, punchy, pithy statement. And man, I struggled for weeks leading up to this thing to come up with the words. And going into the event, I just, please, Lord, help me find the words when the event ends and I got the microphone in my hand. And what I said was that remember that the value of a business is a function of how well the financial capital and the intellectual capital are managed by the human capital. And you better get the human capital part right. And that's what I would leave your audience with. And the interesting thing is those words have been literally shared around the world, translated into a multitude of languages. They show up in posts, on LinkedIn profiles, college curriculum. It blows my mind where those words have landed, but that seems to resonate. So that's what I want your audience to remember. You better get the human capital part right.
Dave, it's been a fantastic conversation. If listeners want to reach out to you, where should they head to?
Yeah, thanks again for having me. It's been a lot of fun. If listeners want to connect with me, they can find me on LinkedIn at Dave Bookbinder. If they're interested in learning more about the books, they can check out newroi.com. And if they want to learn more about the podcast and listen to what I have to say with my guest every week, check out Behind the Numbers with Dave Bookbinder.
Amazing. Cool. Thank you so much, Dave. It's been an absolute pleasure. I've learned a lot about valuations, especially the human value in valuations, which I think is the bit that we always forget about because it's not tangible, is it? Like we said before. So yeah, amazing. Thanks so much.
Thank you.
That was Dave Bookbinder, and I don't know about you, but I'm now seriously rethinking how many invisible assets are quietly powering or dragging down the businesses we build. If you want to go deeper on this, check out Dave's books, especially the new ROI and his latest evaluation toolbox for business owners and their advisors. You can also catch him every week on Behind the Numbers, wherever you get your podcasts. As always, you can find links to everything we mentioned in the show notes, and if you're enjoying these conversations, the best way to support the show is to hit follow, leave a review and share it with someone who's scaling up, but doing it their own way. Thanks for listening, and remember, you don't scale alone, but you do get to choose who's on the journey with you. Until next time.